Chapter 4 Forward and Futures Examples. In Chapter 2, we have studied the basics of forward and futures contracts and how they can be used for hedging. In this chapter, we will revisit this topic, and the focus will be on the interest rates and foreign currency futures contracts, as they are heavily traded in the global futures markets. We will see how the contracts are quoted and traded in practice. Here's the outline for this chapter. First, before talking about the interest rate futures, we will study the fixed income instruments, in particular, the U.S. Treasury bills and Treasury bonds. We will then introduce the interest rate futures. The underlying assets of these futures contracts only depend on certain interest rates. In other words, by analyzing them, it is possible to recover the term structure of the interest rate that the underlying assets are tied to. Lastly, we will briefly talk about the currency futures. They are closely related to the term structures of the foreign currency in consideration, and are widely used for short-term hedging of the risk in foreign currency. Now let's start with the first section, fixed income instruments. One of the typical examples of fixed income instruments is the bond. A bond is a debt instrument requiring the issuer to repay to the lender or the investor the amount borrowed at a specified maturity date, plus periodic coupons as interest payments over the lifespan of the bond. The coupon rate represents the cost of raising capital and is dependent on the credit standing of the bond issuer. If the bond issuer does not default, a bondholder holding the bond till maturity is assured of a known cash flow stream. In the United States, short-term debt instruments issued by the government are called Treasury bills, T-bill for short. They are issued in denominations of $1,000 or more, with fixed terms and maturities of 4, 13, 26, and 52 weeks. Due to the short term, they are highly liquid and sold at auctions. There's no coupon payment for Treasury bills. They are sold on discount basis. That is, interest is subtracted from the par value to derive the purchase price. The price of a T-bill is typically quoted per $100 of the face value, also known as the dollar price. Quotations are often given in terms of discount yield. The discount yield, or discount rate, denoted by D, is given by the following formula, which can be considered as the annualized percentage of the purchase price below the par value. Note that we assume that there are 360 days in 1 year for the annualization. It is clear that the quoted discount yield is not the true yield to the security holder. The true yield, namely the rate of return, is the percentage return on the price paid. Instead, we use the coupon equivalent yield, also known as the investment rate, to measure the true yield. Let y be the number of days in a year, which can be 365 for a normal year or 366 for a leap year. Then, the investment rate can be obtained for the following two cases. Let P be the dollar price of the Treasury bill. For the T-bills of no more than half a year to maturity, the investment rate, denoted by I, is the rate of return of the investment being annualized directly. Note that here y is the exact number of days in a year, and t is the exact number of days to maturity. Here's a table of sample T-bill quotations for February the 13th, 2015. The first column is the maturity dates of the T-bills, and the exact number of days to maturity is listed in the second column. Both bid and ask quotations are given, in terms of the discount rate. According to the formula defined in the previous two slides, it is not difficult to get the corresponding true yield for the cases when the time to maturity is less than half a year. We listed the true yield for the asked discount rates in the last column. For the last quotation, highlighted in blue, the calculation of the investment rate is slightly more complicated, and we'll see in the next two slides. For T-bills with more than half a year to maturity, the investment rate I satisfies the following equation. The seemingly complicated formula actually follows from the idea that the investment rate I is compounded semi-annually. More precisely, for the first half of the year, the growth rate is I divided by 2. And for the rest of the days that exceeds half a year, the growth rate can be obtained by the exact number of days times the daily growth rate. Rearranging the formula, it can be shown that I is the root of the following quadratic equation. Now let's give the details of how to obtain the investment rate of the T-bill with 300 days to maturity, given the quoted discount rate is 0.153%. First, we can calculate the dollar price P from the discount rate. Then, with the exact number of days for the year 2015 being 365, the investment rate satisfies the following quadratic equation, where the coefficient A, B, and C can be obtained based on the formula derived in the previous slide. Solving for the roots, we have I equal to 0.155%. Besides Treasury bills, the U.S. Treasury offers two types of fixed income securities with maturities more than 1 year: Treasury notes and Treasury bonds. They are essentially identical, except that notes have an initial maturity of 10 years or less, whereas bonds have a maturity in excess of 10 years. Both Treasury notes and bonds pay coupons semi-annually. More information on U.S. government securities can be found at this webpage. Singapore government offers similar securities as well. Information is available at the following website. We will continue this section and talk about how the price of the Treasury bond is calculated and quoted in the market in next lesson.